Okay, traders, so welcome to Traders Talk. So before I introduce our speaker, just a little bit about the purpose of Traders Talk itself. Now, Traders Talk's purpose is to give you the truth of trading by interviewing top traders who trade for real and give you different ways to trade the markets for consistent performance. Now, today's speaker is Ian Murphy. Ian Murphy is a successful private trader, trading his own account using trend following, swing trading, and day trading strategies. He has studied various facets of trading with a number of experienced traders, including psychology and trading methods with the well-known renowned trader Dr. Alexander Elder. He's also worked closely on technical analysis and trading strategies with Kerry Loven. Throughout his trading career, Ian has maintained detailed records and a diary documenting the highs and lows of his trading experiences. Over time, he identified the most important aspects of the journey as he began to interact with other traders. The lessons learned have been brought together in his new book, Way of the Trader. Based in Ireland, after college, Ian Murphy trained in electronics before traveling in Europe, North Africa, and Central America. He returned to Ireland to work in the metal recycling industry, eventually specializing in precious metals. This brought him into contact with the financial markets, and he has been an active trader ever since. Ian, it's with great pleasure that we welcome you to Traders Talk. How's everything with you today?
It's great, Thiru, and thank you for inviting me on. Thank you very much for having me.
Yeah, it's very good. I'm sure a lot of participants have been telling me time and again that they're very keen to listen to this interview. In fact, I think I got to know about you after reading the book, The Way of the Trader. In fact, it related a lot with the way that we approach the markets, and that's why I thought of inviting you in here and to give really good value for the audience today, Ian.
That's good. That's great to hear. Thank you.
Just to get into it then, so I just want to know a little bit, so how did you get into the world of trading? So just a little bit of the format for the audience over here. So we'll know a little bit background about Ian. After that, we go into a bit of the theory and the and how he trades, the style of trading and all that. And then we'll go straight into the practical side where he will answer the questions and show you on the chart itself. So understanding this format, now we go on into the first part, learning a little bit about you, Ian. So tell us a little bit about how did you get into the world of trading? Firstly, how old were you when you started? What event triggered your interest? And do you do other things along with trading, or you just do it full time?
Thank you, Thiru. My entry into financial trading, I actually don't have a background in economics or finance. When I started to get into trading full-time, I thought that would be a disadvantage. But as it turned out, I believe it's firmly an advantage. But I had my wife's family business were scrap metal traders, had been for a long time, and they built up quite a substantial business. And as you said, I originally trained in electronics. I also, I was just looking today, I worked on the first Apple II computer back in the late 70s. So I'd always been into tech and electronics, but traveled overseas quite a bit with that. And then I came home. I was based in London for a few years. And at the time, things were really starting to take off in Ireland. A lot of US multinationals were coming in here. I had done time with some US multinationals, the likes of Westinghouse and Verbatim. And I went into the wife's family business where they were servicing the metal waste from a lot of US manufacturing firms. So I started trading metals physically, literally organizing trucks and sending them out to collect tons of metal and consolidating them in a warehouse, processing the metals. And then as that got larger and larger, we started to buy in physical metals, mostly non-ferrous metals now, copper, stainless steel, aluminium, that type of thing. And we started to ship it to the Far East. That market was opening up as well. We were sending it out in containers. 20, 25 tons. Then we started to deal with ferrous metals, which would be anywhere between 3 and 12,000 tons in ships from a port or from a quay. And then we started to trade with other traders. So we were consolidating cargoes. And we found as well, with the time it took for us to consolidate cargoes and ship them, we needed to start hedging. So we got into some futures there. We were hedging these metals. And that's how I got into trading. I came it from the physical side. And, you know, I was chatting to somebody recently about the bid-ask spread that you often hear about in the financial markets. And when I started out, the bid-ask spread literally took place with two people in an office shouting at each other.
Oh, interesting. Okay.
Settling on an actual price. So I never thought that would stand to me. And I always thought the financial markets, I had an image in my mind of Wall Street. But the more I came on, I realized the more I came back to the old days to get to the heart of what trading, financial trading is really about. I also kind of did a stint, took some time out during that because it was quite intense business. It was 24/7. I did 2 years as an insurance loss assessor. I was managing an office of loss assessors that had opened in Ireland. And that involved going out, and when somebody's house burnt down or their business was stolen or whatever, we'd go out and process the claim. So I really got a very interesting insight into risk assessment, risk management, risk profile. Again, very physical, very tangible. And, you know, I always say when dealing with traders and are using our risk management techniques, that we're very lucky when we're trading the financial markets. The only thing we will ever lose is money. That's the only risk, because nobody's going to get injured or hurt or killed, and there's nobody going to sue us. So assessment and management of risk, some people struggle with it in the markets, but it's actually really simple when you look at how other risk assessment and management is carried out.
Interesting.
Yeah, I would say then we had our own firm. We started up our own firm in the financial crisis, 2008, 2009. And physical commodities, as you know, with the how the cycle works between various asset classes, physical commodities increase in value in recessions. So when things were pretty bad here in Ireland, you know, 2010, we had the Euro financial crisis. The Irish banks were bailed out. There was talk of the euro might be gone. The metal business was booming. And we did well, and we went out on our own. And then more and more, I kind of needed to move on. I was looking for what I want to do in the future. So I became a full-time trader in 2014. I'd been trading part-time, I'd say, you know, since the late 1990s. I started off with the old traditional full-service broker where you'd they'd be live, you'd phone them and place your orders, and they'd physically go and do it. And then kind of online trading came on. I was with the likes of TD Ameritrade, Interactive Brokers, Saxo Bank. And more then I became a full-time trader in 2014, trading my own account, based in my home. Then later on, I started Murphy Financial Trading 2016 from a rented office in that. And my website, murphytrading.com, I launched that. And just there recently, I've launched an online trading course. And the reason I've kind of I'm wearing two hats in that I'm providing mentoring and training services to traders and also trading my own account is because I'm primarily a trend follower, Thiru, which means that I've got lots of time in my hands to to write books and do interviews.
I understand.
With weekly trend following, which is my preferred style, and it's a style I would recommend to a lot of part-time traders. You really only need to take action on the weekends. And when you have a very strong position on in a good trending stock, and we'll have a look at one like Microsoft in a while, there's not a lot to do. So I found that going into the education side of trading more kept me engaged with the markets, kept me involved, but also took away the urge to be doing something and to be closing out a position when I really need to sit back and let it run. I also found that in education, and this is something I picked up from Dr. Alexander Elder, who, when I was working with him, you know, he'd be well renowned and he's got a lot of books, an international bestseller on trading.
Yes, yeah, most of the people here will be familiar with Dr. Alexander Elder.
Yeah,
Yes.
we're quite familiar. And I did a workshop with him there earlier on before the lockdowns in Amsterdam and the Netherlands. And he always told me that, would they say that teaching benefits the teacher as much as the students. And that is very, very true in trading, because we can have very fixed concepts about the strategies and the trading style we're using. And we can kind of get pigeonholed and get into a bubble on it. But when you meet people who are experienced traders or new traders, they can often come at it from a very different perspective that you haven't considered. And their questions will often tweak something. And of course, the other issue, as you know well, is there's no monopoly on trading skill or experience or talent. And the person who I might meet today and starts trading or listening to this webinar could be the best trader I will ever meet. They might have a completely different perspective on it than I would never considered. And that's been an added benefit of working with traders, mentoring and writing books and doing all that sort of thing with the website. Exposure to very intelligent people who are non-conceptual in their thinking. And those are really the keys to success in the markets.
Great stuff, Ian. That's a very nice background that we heard. I always find it very fascinating. I was telling it on the other traders that we have interviewed is how when you look back, like Steve Jobs says, how the dots all connect together and finally make you to come to where you are. So in your background, you started servicing metals, trading it, hedging it, and then you became an insurance law assessor, which gave you the risk assessment, side of that, which is so important in trading. And then you finally go into trading. Is interesting, isn't it? How when you look back, everything actually connects all together. There was some kind of intelligent orchestration behind it, right?
That's something you see common with most traders, professional or successful traders. We all begin from a very different place and undergo a very different journey, but we end up at the same final destination because the financial markets are essentially, if you were to extract the financial or economic activity from society and display it on a screen, that's what the markets are. So all social experience we've had is relevant.
Very true. It's absolutely true.
Regardless of what your background, your profession is, it's incredible when you go to workshops and meet traders and speak to them. They're coming at it from a very, very different perspective, but they crystallize in the same place eventually.
Exactly, yes. The destination is the same, right? Eventually, you have to.
Exactly, yeah.
There's some principles which always keeps recurring that you have to master. Just one quick thing before we get into the meat of today, which is all the technical stuff. I just want to know a little bit. I know you were talking about the background and everything. Would you say that what was that single specific event that then triggered you into financial trading? Was it a friend or was it just some TV that you saw or was it an advert? What was it eventually?
It was kind of two things. For me, I think that great, that moment, that light bulb moment when I realized that financial trading, inverted commas, is not really about finance or trade. It's about applied mass psychology. Now, that's kind of a throwaway cliche, and you hear that a lot, but it is so true. And we tend to forget that we concentrate on the finance and the trading, the kind of end result, but we forget what's driving it, which are people, which are hoping to make a profit. And that's what it's all about. And the emotion that's attached to that, the fear and the greed, even with so much algo trading these days, but the programs are behind it all is somebody attempting to make a profit. And when I got into trading in the early years, I probably spent 15 years at the tech, looking at charts, the perfect platform, technical indicators coming out my ears and all of that. And the more I got on and the more I began to hang out with professional traders, I realized that the money is made and lost in psychology. Because, I've never yet met a trader who didn't eventually figure out how to use their platform or their technical indicators or how to read spreadsheets. We all get there in the end because it's not that difficult. And by and large, people who are drawn to the financial markets tend to be above average intelligence. Now, that can be a disadvantage as well, but
I'm sure we'll get to that later on. Yes.
That's another story. And you know, we can go off on a tangent and get down the tech route. And I constantly have to pull myself back and the people I work with back to the simple applied psychology. That's really, and that for me, once I began to say, okay, step back from the tech and look at yourself. The answer is inside you, not in the screen, because without getting too deep into it, and this, you know, ultimately you're trading against or with yourself when you're trading. And it takes a long time to realize that. And that for me really was the moment when I began to look at psychology. And that's where the book, The Way of the Trader, the name came from. And that's why at the very heart of the book, at the core, is I share some psychological tools which I always use and I believe traders need to use if they're going to be successful in the markets.
Yes, absolutely. And I think we're going to come to that in the later part of the section. You know, one thing I must agree with you is that one part is understanding and nodding and saying, yes, that's true. But another part is, you know, it becoming part of you. And that takes a long process, like you said. And I always remember this part where you just said where, you know, you finally start to realize that it's just a battle of your own self, you know, it's just a battle of your own mind, but it takes a long while to really process it. And actually, it reminds me of Ed Top in New Market Visits. He says the same thing too,
Yes.
the beginning part of the book when he talks to Jack Schwager. So I definitely agree with you on that. Now, carrying on just a little bit more. So tell us a little bit about your style of trading. Are you like I guess you mentioned you're more like a swing trader, right? Would you say you're somewhere in between swing and position trading? Because yours is quite weekly trading too, right?
Yeah, I kind of, when I began to take trading seriously, I invested a lot in my education. And I went to the States and I studied with Dr. Alexander Elder. And he wrote a foreword to my book. And he got me into US equities. I believe that the kind of relationship with the financial markets is very different in the States than it is here in Europe. In many respects, they're much more mature, much more educated, the so-called mom and pop investors. And in some regards, they're not. It's different, but I felt that was the place I needed to go. And he got me very much into US equities, US futures. I then also, and he dealt more or less with trading styles, psychology and that. I work very closely with Kerry Loverne down in Alabama. He's a trading coach, a seriously good guy now. He knows his stuff. He's a real data junkie. He was very much influenced by the work of David Weiss, who's working on an adaptation of Richard Wyckoff's methods, which are related to realized volatility, especially average true range. And that's something that at the very heart of what I do, this realized volatility, average true range. And mostly I trade US equities and futures. I trade blue chip international equities. Probably my preferred trading style is weekly trend following, but I do monthly trend following, which is kind of more like technical investing, to be honest, where you're getting entry and exit signals from technical signals rather than fundamentals. I do weekly trend following. I have one or two strategies on that. I do daily trend following, daily swing trading. I also have a hybrid system where I will enter on a daily swing trade, scale out some of the position, and then trail a stop under the balance. So that's a kind of a hybrid.
What's your minimum holding time for a weekly position?
I don't have that because, you see, first of all, when you're trend following, the concept of kind of your target, there is really, inverted commas, no target when you're trend following. So my holding time is until I'm stopped out.
So when you look back, like the average, what would you say?
On successful trades, I have been in some trades over 2 years.
Right.
Not so successful trades. I would have, on a weekly trend following trade, I will usually, if I enter on a price bar, and if that price bar, that weekly price bar is not positive by the close on Friday, I will close out the position.
Right, okay.
All my entries are on triggers. I require a series of signals, and when those signals are present, I get a trigger to enter. And one of the triggers is a positive price bar. I can show you in a minute.
Oh, yes, yes, yes.
Where a price bar has washed out the recent lows and closed positive. And then everything is entered as a bracket order. Sometimes I put in a bracket of 3 orders above the price and 3 stops below to scale out. So all my strategies, I never enter unless I can exactly calculate my risk to reward ratio, and especially my risk based on my entry and my stop price. And I have a very strict risk management criteria. I call it the 5 limits of risk, and I laid this out in the book. And where it's kind of related not only to my position sizing, but also the liquidity of the position I'm trading. And this is an issue at the moment, particularly for equity traders on this side of the pond. Liquidity has dried up in a lot of equities. A lot of stocks have now become so-called penny stocks, if they're trading less than $5. Mm-hmm. And the way a penny stock moves on the price axis has a profound influence on the percentage change. As the price drops, the change is more. So your ticks are going to be difficult. And that's something to watch, and 1 or 2 problems I've seen recently speaking to equity traders.
Right. Okay. I think one of the main things I think the participants, the attendees need to understand is because when I was reading your book, I saw that a lot of the methodologies really resonated with what we were doing. And that's why I thought this interview would be really good for our audience and for any of the new people that are coming through. Because at the end, they have to understand it's a systematic methodology with the right psychology is what's going to get them consistent performance. And that was constantly drilled through your book, which was really good, The Way of the Trader. Now, moving forward, Ian, on the entry side of things, so maybe you can start sharing your screen if you want to. At the moment, I just wanted to ask you, is there like a concept to all your trade setups that you take?
Every trade, I have a very specific entry and exit criteria. But the one common thing of all the entries is I generally enter on a price, a washout or reversal. I'll show you. Can I share my screen?
Yes, that's right. I'll stop my share over here. And then
enough talk. Let's get to the charts.
Exactly. And I'm sure the attendees are all looking forward to that too.
Okay.
Great. Good.
Okay, you should be seeing candlesticks there.
Yeah, if you guys can see it all okay here, Ian, okay as well, just type in yes into the chat box. Then we can be very sure that it's all going. Okay, great. I think that's a good to go then, Ian. Yeah, you can carry on.
Okay. What I did in the book is I put a lot of thought into it, and I sat down and I said, I wanted to give strategies which would be useful for beginners, but also be useful for more experienced traders who have difficulty getting their equity curve to remain positive. So maybe go back to basics for them or give them some new ideas. So how I laid it out is, and this is how I look at the markets, I think of the markets in terms of time frames. And bear in mind, I'm primarily in equities and a futures trader. Forex is that little bit different. So I think of the market as, the traditional, the old method, the Dow, as in a tide, waves and ripples, monthly tide, weekly wave, daily ripples. So I have monthly strategies, daily strategies, and monthly strategies, weekly strategies, and daily strategies. And that's kind of how the approach I take. And this is the first one I have. This is a monthly trend following strategy. This is the S&P 500 SPY ETF, which tracks that. Very simple strategy. I've just manually written on here entries and exits. This is based on a crossover of MACD histogram. Very slow settings on the MACD histogram. And you can trade this type of strategies in 2 ways. There's an aggressive or a conservative approach, and I adopt that to all my strategies. If you're a more aggressive trader, you're prepared to take on more risk, which may include more whipsaw. There's one approach. If you're a more conservative trader and you're you're that little bit more risk averse, you'll have to take on more lag in your trading. So that means less entries and exits, but you'll have to sit through larger drawdowns. And that's just, I call this the tidal strategy because it moves through up and down with the tide. And US market, very simple. This one is quite popular. it's kind of like a technical investing style, where you will exit on the last day of the month on the conservative approach when you have a crossover of the lines, when the MACD histogram is below 0, and you will enter when it crosses above. And then the more aggressive approach is, this is a 10-period exponential moving average calculated from closing prices. And when more than half a bar trades above this 10 EMAC and it closes above it, you enter or stay long. And when more than half the bar trades below the 10 EMAC and closes below it, you exit or stay short. And if I just go over, you're still seeing all this, I guess?
Yes, yep.
What I did in the book is I put out all these charts. They're in black and white in the book, unfortunately, the limitations of print, but they're on the website at murphytrading.com. These are all available to view in full-size color charts. And I just went through the entry criteria there, the 10 EMAC, that type of thing. And when you're entering an exit, what the signals are in that. And then I just included back-tested results for that. And very simple. Back-testing results is a kind of a thing with me. It's all grand in theory, but rarely translates into a trader's equity curve in their own account. So I
agree. We were talking a little bit about that yesterday, but I'm sure we'll be going into this much more in detail later on too.
So this is just like a spreadsheet, entry price, exit, how many months we're in the trade, the gain and loss. And this is not accumulated. These are individual in and out taken as they are. The SPY ETF only became available to trade in April 19. So I went back and correlated with the Dow back to 1963. And in this strategy, this is a monthly trend following strategy using the SPY ETF, which tracks the S&P 500 using MACD histogram signals. This is the conservative approach. The average holding was 26 months. In answer to your question in this strategy, you can see here is nearly 3 years. It is 3 years there actually, from November 09 to June 15. And the average gain when you were in a position was 24.89%. This one here from 05 to just 2000 at 177.46%.
Carry on.
This type of strategy, Thiru, is what institutions are using.
Right, yeah, I can understand. I can appreciate.
I've spoken to a lot of fund managers, money manager people, family office people. This is the type of thing they're using. MACD histogram crossover. Some of them also use Atr channels on a weekly chart for entries and exits, but that's kind of the thing. So
it's a very steady result. I can see that's why the institutions will definitely be favorable of that,
Yeah, but you see, it's not without its drawbacks, because if you look right now on this chart where we're trading, and we're due to open here in 34 minutes in New York. This is, I haven't written it in here because I haven't updated that, but that was an exit. This position exited here at this point just below $260. And it's since recovered more than half of that. Now, I haven't put a Fibonacci on that, but I know it's coming up, meeting resistance at a 50% retracement of that.
Ian, just a quick summary for the participants so that they get clear. So let me look to understand. So where you get the entry signal is where the blue arrow is. Is that what it is? Is that right?
Yeah, I've manually put these in. These are not automated signals. That's just stuck on there in the chart. I can move that.
I got you. But basically, that's when you enter the trade. Is that right? That arrow? No. Or that's where you exit. Or
enter is blue, red is exit. And that's
okay, got you.
You enter that, and that's
that signal of the blue arrow is given when the MACD crosses. So the orange line crosses over the blue line. Is that right?
There are two ways to trade this strategy. There's a conservative and an aggressive approach. On the conservative approach, if you line up down there, it's when the MACD histogram crossed above the 0 line. Now, this isn't your standard MACD setting. This is a proprietary indicator that I have on the website, and this is TradeStation Global, by the way. I should have said that I'm using here. If you look, the settings are very slow on this, 18, 36, and 9, which are not the standard settings.
Got you.
Okay. That's not what's coming out of the box. And one of the reasons I like TradeStation is this has an easy language, and the kind of fascinating story with TradeStation is 2 Cuban immigrants who were professional violin players and then went on to get into tech software.
Right.
To Florida. The background of TradeStation is in software, and with TradeStation you can write anything you want in the background, your own indicators. You can actually get into them and program the language. You see here, edit easy language, and you can get them literally to do anything you want. Mm-hmm. And this was something TradeStation is that I got into in the States with Dr. Elder and Kerry Laverne, and really bit of a learning curve if you're not used to it, but definitely worth the effort. And in my experience, a lot of private independent traders like me are using platforms like this. So right. Sorry, in answer to your question, there's 2 triggers on this. Mm-hmm. When the MACD histogram on those low settings closes above the 0 line, which is also a crossover in lines, histogram above, lines crossing over, it's the same thing. That's an entry on the conservative approach.
Got you.
On the aggressive approach, you don't use MAC histogram. It's just purely price action relative to a 10-period exponential moving average calculated from closing prices. And this is another thing on moving averages. These are calculated from the close. Most platforms do this by default out of the box. But you can change that to the lows or the highs or whatever you want in this, and completely changes the signal, and that's another strategy in itself.
Right.
Closing prices are just, and I wanted this because it was in the book, and most retail traders don't have access to this type of software. I wanted it to keep it really simple.
Got you.
And you could use it on any freely available platform online.
So you just mentioned the aggressive entry is just as soon as it closes above the moving average?
Correct.
The 10? Right.
More than half the bar trades above the moving average and closes above it.
Got you. Okay.
Because it's both. Basically what you're looking for, in simple terms, is you're looking for the trend to change to the upside. You're looking for bullish price action, confirmed bullish price action, because bear in mind, this is on a monthly closing basis.
Yeah,
so these candles can be all over the place during the month, but where they finish out, because so many traders settle accounts at the end of the month.
Yes.
And they make decisions, and that's reflected in the price. As you know, every single market participant either buys or sells or continues to stay in the position they're in or continues to stay in cash. And eventually that will crystallize in the price. And especially then in every third candle, when when these are quarterly closing out, you'll also get a lot of movement at that point.
Got you, I understand. So on the aggressive, it's just based on purely price, no indicator. Is that right?
Well, it's based on the 10-period this moving average.
But no MACD. You're not using MACD on the aggressive one. Are you still?
No MACD.
Oh, no MACD. Okay, got you.
Just as we're honest, there's a lot of commentary at the moment about sell in May and go away. And I did an analysis on the what months back to from 1963 up to when this closed out. There was actually a position open when I did it. There is, I won't spoil it for you, read it in the book. There is a correlation going back to 63, what months are most active, how many entries and exits there are in particular periods. So, yeah. And it's not what you think.
Yeah, it's always good. I mean, I must agree that in the book there were really nice insights, and that's why it related with a lot of what we do is quantitative. You give statistics, and so it all absolutely makes sense. And I think that's how trading should be. I mean, that I would say that's the truth, and that's what gives you the conviction to keep going forward and still stay in the business.
The flood of business in the market tides, particularly in equities, particularly US equities, but also here, you know, in UK equities, the same thing. When you have a huge flood of volume in and out of the markets, it makes a difference on how your trades are going to perform, particularly in terms of execution, getting fills at the price you need.
So that's good, Ian. I think we got a really good understanding of how you enter the overall ideology behind it. Just a quick one, like, do you scale into trades?
Sometimes I do.
Yes. Sometimes you do. Okay, right. Then the other one, what I wanted to ask is a bit of memory check over here, is that what is your best trade to date so far, and what was your thinking behind your entry? I mean, feel free to define what is a best trade. I know most people conveniently think best trade is the biggest profit. It may be not, but I leave you to explain. So what is your best trade to date so far, and what was your thinking behind your entry?
Well, I don't like to tell tales about what very good trades are, but there's a very good one at the moment, and we've done very well out of it. Let me just bring it up here. This is, by the way, this is a demonstration account I'm showing you. For client purposes, I run 2 demonstration accounts, one with TradeStation Global, which is a combined product with interactive brokers. So this is, you know, there's just 10,000 in this in the 3 currencies, and I just take screenshots and show this. But and then I have TradeStation Securities, the US version, you can see down here in the footer. So essentially, I'm running 3 platforms at any given point in time. And these are just, this is a demonstration account. But on a weekly trend following strategy, which is another one I use, I have a strategy that I call the Wilde strategy, named after Oscar Wilde. That famous quote of his, "We're all in the gutter, but some of us are looking at the stars." And the point of that strategy is to identify stocks, you know, a kind of bottom feeding. This is a stock which has fallen from a great height. This is a weekly chart of Twitter here, and gets into a channel, enters a trading range for a long period of time. We can look here, the Twitter was from 16 to 18, 2 years in this channel. Then you identify the channels with a false upside breakout and down. And then eventually, when this breaks out, you have a confirmed breakout, which is a first higher low pattern that finds support on the upper channel level here, or the gutter, to use Wilde's language, and climbs from there. And these are some of the best trades I've done. Because the reward is so high on these, you can afford for more than half of them not to be profitable, and you will still gain over the long run, because the risk reward is so high on them. And so these are some of the best. This is one that's currently technically.
What time frame was that? Sorry, Ian.
Oops.
The one that you showed. Wow, Twitter, right? You traded on. What was that? Was that a monthly trade? Was it
a weekly chart?
A weekly chart. Got you.
We're looking at all weekly strategies now and all weekly charts.
Yeah, nice.
That's just an example I had in the book of that, just to show entries and exits. When I finished up on the kind of last thing I did in the book was one to look at going forward was General Electric. I kind of mentioned what to look for. Here's a stock which had fallen from a great height. Long-term shareholders getting out as volume increased. Appeared to have found a base at $7. And then the question is GE forming a gutter. And that was just over a year ago I posed that question at $7. So I haven't checked this in a while. There's what happened. This would be fairly typical. Now, sorry, what I didn't mention, Thiru, was that the price bars on here, if you notice, they're changing color. Mm-hmm. This is based on Elder Impulse. When MACD histogram and the moving average here, this exponential moving average in the middle, are both going in the same direction up, it's green. When they're going in contradictory or opposite directions, it's blue. And when they're both going down, it's red. So this is a kind of a momentum indicator that changes color. On here also on this weekly chart, I should have mentioned, these are Atr channels. These are a measure of realized volatility based on a 21 period look back window on this. And these here red, this is a trailing stop. This is a trailing stop based on volatility. Again, an ATR trailing stop. I did a presentation on this recently and it generated a lot of interest. And these trailing stops I use on all my strategies, regardless, well, with the exception of the monthly time frame on the 3 weekly strategies, and then on the daily strategies, these trailing stops. In my opinion, they're the best stops I have encountered yet. I have used a lot of stops, a lot of methods. These volatility-based trailing stops are the best I've found. And I've kind of fine-tuned it and gone a bit far and eased back a bit. And I've kind of settled on 2 settings for them. And this is what I'm using on everything now, these volatility-based protective stops.
That's very good, Ian. Actually, it brings us to the next part, which is on the stop loss basis. So we can see what kind of stops you're using, which is volatility-based stops. And so how does this work? Do you want to tell us a little bit more?
Yeah. Very simple. When I enter a trade, let me just give you an example now. If we'll kind of dabble a bit in daily swing trading now. When I'm entering a trade, where are we? Here we are. Here's an example. Let's say this is a daily swing trade on the long side, and I'm entering here on this bar. Okay, so we have had what I call a 2-bar washout. Let me go back there. All my entries happen in one of 3 ways. There are 1-bar washout where the current bar, and this operates on all time frames. This is intraday, daily, weekly, where the current bar washed out the previous bar's low and closed higher than the previous close. This is a 1-bar washout. It's a reversal. All the weak hands are pulled out. Buyers came back in. Sentiment of buyers overwhelms the sentiment of sellers, shove the price up. That's a valid entry signal. And unless I'm getting that, I will not enter a trade. This can also manifest in 2 bars. So if we're daily swing trading, this is over 2 trading sessions, 2 days. Washed out the lows, but again, we closed higher. So these 2 combined, if you were to look at the true range of these bars, which includes the gap in the open, it's the same as this. The net result is the same. It just took a day longer to manifest. That is another valid entry. And I have an indicator on my platform that forms a little blue dot and will give you an alert once this price action occurs. I also, on my daily swing trades, use conditional orders to enter. The best invention since sliced pan, I can honestly tell you. All right. Because what they allow you to do in the morning or the night before is program, and I use this in TradeStation, they have very good conditional orders. You program a condition in where this bar has to wash out these lows and then has to reverse and trade back up again before you can be triggered into the trade. And you can set up 3 or 4 of these in the morning and leave them. And if this price action happens in that sequence, and if it happens the other way around, it won't work. If it goes up and then reverses, it has to happen in that sequence by using conditional orders. It will trigger you into the trade.
Right. So take out the low and then go up. So it's the root of the price action, basically.
Correct. That's the final trigger. Now, all your other technical indicators have to line up, and I'll show you that in a minute. But that's the final signal to enter. That's what actions the trade. A 1-bar
you can program all of that on TradeStation.
Yeah. Program it's very, very simple.
Right.
I'll show you in a minute. That's a 1-bar washout. That's fine. That's a 2-bar washout, which is the same price action, just took 1 longer. This is a multi-bar washout, and this is a messy affair. I avoid these because I like a clear change in sentiment. Down, weak hands washed out, back up. This messy. So when I'm entering on those,
it's interesting you showed those price action setups. In fact, that's the thing that related with me when I read the book as well, because we teach that to our clients, because the 1-bar washout is what we call a potential swing bar, which is potentially it could form the bottom. and then we have quantified parameters for that. And then we got the second one where you got the 2-bar washout, which is like a primary kind of a setup. So yeah, so really good there, Ian.
Yeah. The where am I now? Yeah, I'll get into that in a minute. You can just program in that activation rule there.
Right.
Where the activation rule is based on price, it has to drop down below, reverse, and come back up again.
Very good.
So that's what they're calling on their.
Just a quick question on that. I mean, have you done any stats on that? I mean, I believe you've been running that mainly on weekly or daily, whichever time frame you've been running it on. How many of them still carry on to go further down and stop you out, and how many of them go in your favor? Like, have you got any stats on that, like reliability?
This I'm on the weekly trend following thing. These are discretionary, and I'm finding these trades, these gutter trades, from fundamental data.
Right.
So in that regard, and we'll get into the back testing in a minute, the stats are kind of irrelevant because the stats are what you're looking for yourself. This isn't an automated thing that's running. I have what I would call an A and a B and a C setup, and I will only take trades that have an A setup. And the success rate in them is very high. It's north of 80%, 82%. Simply because I'm filtering them out. I'm just not taking bad trades. They're not automated entries.
Right. Okay. Cool. And just a little bit more on this volatility based loss. What are they based on? Is it just simple ATR range calculation from the close or from the high? And yeah.
These volatility based protective stops, these are trailing stops, are where was it here? When I'm entering on a daily swing trade, I will have an initial protective stop below the bar on which I enter, which is this one.
Mm-hmm.
And the initial one will be 1/2 ATR below the low of the bar. So whatever the average true range is for this bar based on the look back period you're looking at, and I'm these days using a 63 period look back, which will be 63 trading days on a daily chart.
Oh, you use 63, okay.
Well, I use both 63 and 21. I'll show you that. I use two, and then whichever one is closest to the price, I'll take the exit on.
Okay.
But the initial protective stop is 1/2 ATR below the low of the bar you enter. And that, based on that, let's assuming you have a bad entry and you enter close to the close, the difference between your entry and your protective stop is obviously going to be your risk in dollars.
Right, and that's going to be between your ATR 63 and your ATR 21, right?
No. None of this has happened yet. We're still here entering on this bar.
Okay.
From the low of the bar, it's 1/2 ATR below the low, and that's where the initial protective stop is.
1/2 ATR, okay, 1.5.
No, 0.5.
0.5, you're saying, okay.
It's American.
All right, no worries.
0.5. 1/2 of 1%.
Got you.
As they say.
Okay, so 0.5, okay, got you, yeah. From the low.
Below. This is the initial protective stop on which you calculate your risk. And this should be no more than 2% of the balance of your account at the moment. Larger accounts should be trading small, 1% or even 0.5%.
Mm-hmm.
So that's your thing. And then when the trade, if and when it moves in your favor, then the trailing stop kicks in. And this trailing stop is 1.5 ATR below the low of each of these price bars.
Right.
3-period look back window. And then once that trailing stop gets above the initial stop, you then switch to the trailing stop. Switch to trailing stop when it gets above initial stop. And this chart appeared in the book.
Yeah, good one.
Always being mindful of your position sizing, because your initial position sizing, your risk was from there to there in dollars. But when you get up to here and here, it changes slightly. So if you want to stay in the position, then without adjusting down your position sizing, that is effectively scaling in because it's scaling through compounding, if you know what I mean.
Mm-hmm.
So that's the trailing stops.
So you use that trailing stop on all your strategies on the on the weekly swing trading and the daily, you use the same type of stop loss trading.
On
Is that
weekly
right?
trend following, yes, I use it. On daily swing trading, just as I showed you there, I've I use a different chart. On daily swing trading, this is the standard layout that I picked up in the States. Left-hand side is a weekly chart. This is Vodafone, the London listed Vodafone. Left-hand side is a weekly chart. The right-hand side is a daily chart. And this ties in with the triple screen system I learned from Dr. Elder.
Yes, I've read in his book, The Triple Screen, yes.
The idea being that whatever time frame you're trading, let's say I'm using, this is a daily swing trade on Vodafone. Let's say I entered this guy here, okay? I will look at the time frame which is slower than that weekly, and I will often enter on the one below it. So even though I'm trading a daily chart using daily bars, I'll enter on an intraday chart, and I usually use a 39-minute chart when trading US equities, because there's 390 minutes in a trading session in New York, and that's split into 10 bars is 10 bars in a session. Not so sure about London, how many hours, minutes. There's a 6-marker question. How many minutes in the trading day in London, the equity market? So the intraday chart would be 39 minutes. And
right.
Yeah, the trailing stop then is just on that.
Okay, I got you. I understand. Just a quick one on that one. So since you're trading the active, do you have stats on that? Like how many of them hit your trailing stop and still go in your favor? Like is it 10%, 5% of them? Must be quite low, right? Seems like a really good stop.
I have a help up strategy, I call it. And this was in Way of the Trader. And this is it live at the moment. I did the back testing and the stats on this based on the SSO, which is a US listed ETF. 2 times gearing it moves, or it's designed to move twice the distance the S&P 500 moves. Since last year, these US listed ETFs have been out of bounds for retail traders who are domiciled in the EU and are using an EU broker. But if you have a US broker, you can get around this, or if you have a professional account. So based, again, I went for very simple stats on this one. This was SSO, a full position. I just ran through a $50,000 account risking 2% per trade back to July 06 when this instrument was launched. And then on a calendar year, I just added up the results each year, 15, 20, bad year, 23%, 17%, and so on down, laid them out. Then I also use what I call in the 5 limits of risk, which are kind of 5 rules you need to adhere to. One of them is the 6% limit of risk. And when your loss for a rolling calendar month has exceeded 6%, you stand aside.
I read that part. Yes, yes.
So this is what happened here in 2011 when we had all this hassle going on. We had 3 losses in a row, which exceeded 6% of our account. So the following trades were not taken.
Got you.
Because of the 30-day rolling month had elapsed. Then took the next one a loss again, and so on. And it kicked in a second time. So in that year, kicked in twice. The loss for the year because of that risk management was just 6% in that bad year, and 15 in that. And then 2013 we went on. And
But I can't stress more the importance of knowing the drawdowns. I mean, I always keep drilling that to all our students, so I can't agree more. It's really good stuff there, Ian. Very good.
This is a strategy I've looked to automate. With another trader I work with in Belgium, we have a number of strategies, automated strategies running with the firm in Chicago. You just basically give them the software. It's on TradeStation. Give them some money and they run it, and you monitor the strategies remotely. This is a candidate for that. There's just one final thing I have to do on it. And now the gains in this is an average gain of 10.89% per calendar year without leverage. Obviously you're getting the leverage or the gearing in the ETF, and you can see there risk reward ratio is just below 40%, which is a ratio of 1 to 2.5, which is another one of the limits of risk. I don't think you should be looking at anything higher than 40%. And it's about a 50-50 win rate, slightly more.
It just reinstates the point of psychology once again, isn't it, Ian? To realize the profits. It's just so true, right? It's just so important.
I found, I went into very comprehensive back-tested results, and with TradeStation, it's really incredible what you can do, and you can do optimization and back-testing in the strategy and the whole lot. When I was working with real people, real money, real accounts, the spreadsheets made more sense because, unless you're very much into tech, that's what a lot of traders, particularly equity traders, I think Forex traders might be that little bit farther ahead in tech terms. I also find the demographic of clients I work with, that little bit older, maybe coming close to retirement or retired. So I find that the spreadsheets work best for them, that can relate best to them.
Just final question before we move on to the last part and then the Q&A for the attendees. I'm just aware of time too as well. Is, this trailing stop that you got on the volatility, 1.5 ATR from the low.
Yeah.
So as I was asking, I mean, out of your trades, what have you seen like roughly that the trades which stop you and still carry on in your direction? And how many times has it fallen below that line and has proved you right in the sense that you've got out early, you minimize your loss, and then it went around the turn? What would you say it would be?
Well, how I deal with that is I look at trading campaigns. And, rather, I would run a campaign based on a market, based on an industry sector. And this results I showed you would be a campaign based on the SSO geared ETF back to its launch. But you see, because I like a whipsaw strategy, I will re-enter.
You will re-enter. Got you.
Yeah. Once I'm stopped out in the trailing stop, that it's not over, because here's a perfect example.
But how many times does it do that on this trailing stop? Because it looks like it's quite a solid trailing stop, by the way. It looks like it's a good reliability trailing stop.
Yeah. Honestly, I don't have the stats on it, but
all right.
This is a perfect example here. If I can just put the screen forward, what we're looking at here is, this is October of last year up to the beginning of the sell-off with the COVID-19. If you remember this Monday morning here, this February 24, I was actually in a position in futures here, and I got out on the Sunday night before. And this is a classic, beautiful trend here the whole way up along. But halfway through here in the beginning of the year, we were stopped out, re-entered because the signal set up again.
Got you.
And on this strategy, I look for 6 signals, 2 from price, 2 from these proprietary help indicators, which are based on US stocks making new highs and new lows on a monthly look-back period. And this is the VIX, the volatility index. So I get 2 signals from here, 2 from here, 2 from here. And if all 6 are present, I take the thing. So that was a whipsaw, back in again, caught the rest of it. And that's a dividend, of course, because this is tracking the S&P 500, you're getting dividends. And good, if I just, before we finish, I want to show you where we're at the moment. Right here on the bounce, this reaction rally or recovery, or a Nike swoosh, as some people are calling it. 2 signals were present in price, 2 signals were present in the help indicators, but only one of the volatility signals was there. So this was a beautiful gain, well over 30% we've had off the low, but the strategy didn't take it. In the conservative approach, it wasn't taken. An aggressive approach, this was taken by a number of my clients. This exact type of strategy. And they've sat in this the whole time. And you can see the volatility-based protective stop here is currently at 99.40 on it. And this is a classic trend following trade. You get in when the risk is highest and you stick with it. The temptation to get out here when the little island of 3 bars was enormous. Again, we're experiencing a pullback. We'll be opening the US market here in 3 minutes. This might pull back. To stick in this requires a lot of discipline and patience.
Of course, no, definitely. I definitely agree. Yes.
You can see
Ian, now going into the target part of the of the presentation. I always remember page 77 of your book on the way of the trader. That was really good, where you talked about the target measurements and all of that. I just want to ask a quick one on that, which is, do you have a predefined target, or do you exit based on discretion?
Nope. Right-hand chart here, daily swing trade. Let's say we entered in Microsoft here in this bar. We would have had a 2-bar washout. This bar took out the previous lows. MACD histogram crossed above. Elder impulse turned green. Volume was dropping. So those would be the core signals for, I call this a diesel strategy because it's also based on a price compression. If you look here, I have these bars programmed to turn red when the Bollinger Bands come inside these ATR channels. That's a classic price compression, very popular pattern in the States. Didn't have a compression here, but we had a washout in the thing. If I had entered this position in Microsoft, and this is a daily chart here, and this is a daily swing trade, I would scale 1/3 or half my position out after a 1 ATR move to the upside. So based on when I entered, I calculate, bear in mind, my stop is 1/2 ATR below the low, which would be here somewhere. And after this move to the upside, which would be in real terms probably on this price bar, I would scale out 1/3 of the position there. Another ATR move to the upside based on the original entry would be up here. I would scale a second third out up there.
1 ATR from your entry, right?
From the entry.
Yeah,
so
got you.
Based 1, 2. And then I would trail a stop under the balance. So let's say we bought 90 shares in Microsoft. I'd take 30 off the table here.
Got you.
Another 30 off the table here.
Got
and
you.
Trail the stop under the remaining 30.
So they are the bonuses, if you may call it like that. The last 1/3 is the real bonus, basically, right?
Exactly. And you asked about scaling in. If I was to scale in, I would scale in here. Because we pulled back, we found support on the rising EMA, we closed higher. I would scale in here if I wanted to scale in, or not scale out. So if the price action I felt and the price, the trade was about to trigger, I just cancel the trade and let it run, let the entire position run rather than scaling in. On occasion, I've scaled out and scaled back in.
Got you. Ian, just a quick question on the last 1/3, right? Which is, so do you have a target for that, or you just let it run all the way? You just keep trailing?
Let it run.
Ah, nice one. Okay. It's so similar to one of the strategies that we trade cash in. It's exactly similar. So 1/3 we scale out, and the second third we have a target, and the last one we just let it keep running. So the guys who are on it, you totally understand. That's why we totally resonate with your style of trading, and it's a really good way for the guys to see another way as well, and especially on bigger time. It's really, really good.
One of the huge advantages of scaling out, and people don't consider this, is because it flattens your equity curve. You're getting a steady trickle of money coming in. And rather than concentrating on what you've lost, because when a trade performs well, you wish that you had carried the entire position through the life cycle of the trade.
Yeah.
But the other way, that can all go against you, and you can lose it just as quickly.
Exactly.
So you get steady cash flow by scaling out. And a lot of institutional and hedge fund people who are managing money like that, because their clients like to see a steady cash flow coming in rather than lump sums of money.
Very well said, Ian. I mean, I couldn't have explained it much better. So absolutely. And I also think about it in real life, right? I mean, as a trader, what are you doing? You're buying it. And then when it gets to profit, of course, you want to sell 1/3 of it, at least to, lock in your profits and preserve your capital at least, isn't it? I mean, that's what you do naturally in real time, in real physical goods. So why should trading, on online virtually should be any different? So I think it's absolutely right. And it keeps it steady as well.
Yeah, and I suppose you asked me earlier on, what was the one kind of big thing I learned, the light bulb moment. Something else I also realized that was when you enter and exit a trade, for most of us, that means we have cash in our account and we buy whatever instrument we're trading, and then we close out and we go back to cash. We're not really entering or exiting a trade. What we're doing is moving from a position in a currency, a fixed strong currency, would hope probably pound sterling for the UK or dollars, into a position in equities.
Mm-hmm.
And to be aware that cash sitting in your account is a position. You've made, you know, and from a psychological perspective, that really made a difference to me. Sitting in cash, inverted commas, doing nothing, is a trading position.
I definitely agree totally in that. In fact, you know what, Ian, I mean, that thing that you just last shared, sitting on cash, you know, it's actually effectively good trading itself. I mean, it's mentioned in your book too. I mean, that is plastered all across not only trading books, but investment books as well. I always remember Warren Buffett and Charlie Munger, you know, and Charlie Munger always would tell Warren Buffett, you know, like, you know, stop, you know, just for the sake of putting something on, stop reaching your hands and just go out. And sitting on cash is always much better sometimes when you don't have the right opportunities. Absolutely, absolutely right.
You know, I'm conscious of time. We've gone over, but something I got an insight a few years ago. I was at an event in Dubai for family offices, and it was kind of an informal thing going on afterwards. And they had a kind of an informal question around the room. What, you know, family offices, they manage funds for wealthy families and firms and that. They were asked, what do you see as your primary goal as a fund manager in a family office? And incredible. Most of the people in the room said not to lose money.
Nice.
Because one of the secrets of rich people is that they realize you only need to get rich once. And after that, you just need to hold on to it. And
yeah, and you know what, interesting, isn't it? I mean, even if you didn't hear it, you have to learn it through the hard way. And that's what Warren Buffett keeps saying. You know, rule number 1, do not lose money. Rule number 2, look at rule number 1. And rule number 3, look at rule number 1 again. Do not lose money.
And as traders, we should only be funding our account once. And what happens with we put in a lump sum of money and then we keep topping it up. We should concentrate on only funding it the once.
Ian, thank you so much. Just going to the last part of it on the psychology, you know, traders who are listening in and those of you going to look through a recording as well. I had some questions on psychology, you know, like pre-trading routine, post-trading routine, any other practices. But I just realized actually page 107 of your book, Way of the Trader, page 113, you go through that in so much detail. I must say I totally resonated with it because we talk all about that to our traders too. So your stuff really reinstated it, reinforced all of that stuff, and you really even taught more additional stuff. If there's anything one-liner or anything a little bit that you would like to elaborate on psychology for the traders or a take-home message, what would it be?
You know, a lot of people are suffering at the moment because of these COVID-19 lockdowns, and the severity of it depends on which jurisdiction you're currently holed up in. But I can honestly say there has been no, apart from people being in danger from a health perspective, which is never good, there's been no change to my life. And I realized that, you know, as a trader, you spend a lot of time in a room on your own. And, you know, one of the fathers of probability theory, a lot of which is involved in trading, he famously said that all of man's problems are caused by his inability to sit quietly in a room by himself. Now, obviously that applies to ladies as well. And that's the one thing, as a trader, you need to spend a lot of time in solitary confinement. just you and a laptop. And that's a trait you will see in traders. When you meet them at events and you chat to them and get to know them over the years, they're a little bit odd, a little bit quirky. And that's the kind, that oddness, that quirkiness is really what gives them the edge, not the technology.
Great stuff, Ian. Thank you so much today for sharing all of this. I think so much amazing insight. And for those of you not able to digest all of it, there's a recording there too. The last part is Q&A questions and answers, you know, guys, traders, whoever's listening. If you got any questions, just type into the chat box. We'll answer that. As they're typing it in, Ian, I just want to ask you, like, if they want to know a little bit more about you, where do they go to? Where's the place? If you can show that on your screen, that'd be great.
You should be seeing that there, murphytrading.com. Very handsome man there sitting at a...
Totally agree. Yes, yes. And if they want to like contact you, anything, or is there any place, or is there a place in your website where you recommend them going? What
there is, yeah. You have to go through the recaptcha here. I'm inundated with people trying to send me stuff. So there's a contact form there. Go through that, but you can just get me at Ian, IAN, at murphytrading.com.
Okay, great, guys. I'll maybe if you can just put that into the chat box, that'd be great, Ian. Whatever details, and also I do want to also share with the guys the link to get your book too. So I will share that link with them, guys. So I will put that into the chat box too as well. So this is the website to go to if you want to get Ian's book, Way of the Trader. I highly recommend it. I've put the link onto the chat box over there. So if you want to get a copy, you can go ahead under Harriman Publishing. That's the book, isn't it, Ian?
Yeah.
Yeah.
That's through the publisher. You can get it anywhere.
Yeah.
There's a discount on at the moment, actually, but you can get it on Amazon or whatever. It's been launched in the Indian subcontinent later in paperback, and there's 2 versions in simplified and complex Chinese coming out in the Chinese market later on in the year, I think in the end of the summer.
Okay, great. I guess that's pretty much that. I'm just going to quickly look at the questions over here. I think most of the questions are basically on your stop loss and how do you manage it. I think we have already covered all of that. Some others coming on the targets. I think, you know what, we have covered most of it. Is there any final stuff you want to add, Ian, before we close it up?
Not really. I think we've rambled through everything there. We could be talking about it for hours.
Okay, great. I guess that's pretty much it. Trader, that brings us to a wrap. As I've already mentioned, all the links are already there. Go and look at it. We will send the recording over for you guys to look at. And definitely a great recommendation is definitely getting hold of Ian Murphy's book, Way of the Trader. Thank you so much for your time, Ian. And as we always say, traders, till the next time, stay disciplined, follow your trading plan, and keep trading like a master. Thank you, Ian.
Thank you.